Okay, so even though most of what you're going to see when it comes to inventory is inventory based on a perpetual system, we do need to discuss the periodic inventory system a little bit because, oftentimes smaller businesses, they will just do a once a year inventory and they just kind of order their inventory based on what I call eyeballing it. Looks like we're getting low on this. Let's go ahead and reorder it. And then we figure everything out at the end of the year. So a lot of small businesses still do use a periodic inventory system. Not many, but collectively, I guess the number is quite high. So we'll go ahead and do one handout over it. It says here, under the periodic inventory system, the inventory account continuously discloses the amount of inventory on hand. Well, my segue into this video probably gives you the answer to that. This is absolutely a false statement. Everything about this is fine except for this one word here. This describes a perpetual inventory system. Under the periodic, recall, we just basically say, okay, we're going to take our beginning inventory, which was last year's ending inventory, and we're going to add up all the purchases that we made, and then we're just going to subtract out whatever we have left, and that gives us our cost of goods sold, right? So this is false. That's how we do it under periodic. This example is for a perpetual system. Okay? Says here, under a periodic inventory system, accounting records continuously disclose the amount of inventory. Well, that's just what it says right here. So we know that choice A is no good. No. A separate account for each type of merchandise is maintained in a subsidiary ledger. Now, this can happen under a periodic inventory system, but we're still going to mark this as being wrong because, it really doesn't, the subsidiary ledger doesn't really help us all that much under a periodic system. It helps us a little bit, but this subsidiary ledger is mostly set up with regard to a perpetual inventory system, and we've established some kind of a reorder point where whenever the point of sale software that we use, it figures out, okay, we're getting low on this, and then it automatically sends it to some kind of a purchase order form. So even though we can do this, the subsidiary ledger and a periodic inventory system don't really go together. All right. C, a physical inventory is taken at the end of the period. This is going to be our correct answer. And, the reason for that, do we take a physical inventory at the end of the period or near the end of the period under a perpetual system? Yes, we do. We do. But this absolutely must take place under a periodic system because, recall, we're not going to have any information on cost of goods sold or be able to calculate our inventory amount for the balance sheet if we don't do this under a periodic system. Now, our numbers are likely going to require adjustment under a perpetual system, but because the perpetual system is tracking cost of goods sold and inventory continuously, at least we have some numbers to go by if we were to, for whatever reason, to skip this. So absolutely necessary under a periodic system. What's the last choice? Inventory is debited when goods are returned to vendors. Well, here's our problem here. Inventory would be credited, not debited. Okay, let's see what else we have here. It says, and get rid of that. Let's move this up just a bit. I'm going to go ahead and circle choice C so we have it. it says the following units of an inventory item, just some item, were available for sale during the year. Use this information to answer the following, well, it says questions. I only see the value of ending inventory is what? Okay. Well, you know what? There really should be at least two questions here, because in order for us to determine the ending inventory value using LIFO, we're also going to have to determine cost of goods sold. We can't get to ending inventory without getting cost of goods sold in the process. So let's just go ahead and add and cost of goods sold here, because we're going to have to figure out both of these. All right. So because this is a periodic system, not perpetual, we're going to attack this a little bit differently. See, if this was a perpetual system, we would need to know the beginning inventory, and then in order we would need to know every purchase, the first, second, and third purchase. And then in between all of these items, we would need all of our sales. Okay? But we're using a periodic system here, so the fact that we're just given the 60 units of inventory being sold at the end is fine. All right, so what we're going to do is, the first thing we're going to do is we're going to determine the cost of goods available for sale. So our beginning inventory is 10 units at $55. That's $550. Okay. Let's go ahead and get Mr. Calculator involved so we don't have a mishap. Then we have another purchase, 25 units at $60 is $1,500. Okay. Then we have 30 units at 65. That's $1,950, and I do realize that you wouldn't actually clear this out every time. I just want to show you the thought process. Okay, so it's a little bit more drawn out than what you would do. 15 units at $70 is $1,050. All right, so we're going to work backwards because we've got the $1,050. So let's add these other figures in. 1,500. Okay, 5,050. So cost of goods available for sale equals $5,050. All right, $5,050. So we actually need to go ahead and, at this point, and determine what our cost of goods sold is. And it says we sold 60. So we have 15 items here. Remember, this is LIFO, so we're going to work backwards. All right. So let's think about this. There's a couple ways we could do this. I'm going to go ahead and clear this out. We sold all 15 of these units. They're part of the 60. So 15 times 70, and we can just use this here. We've already calculated this before. We sold 60, so we're going to get rid of all 30 of these. And that was at what, 65? And that's $1,950. So that's 45. 15 and 30 is 45. So now we need to take 15 of these units, leaving us with 10. And those are at, what is that? $60 a piece. So we'll have to calculate that because we don't have that number. Okay, that's 900. All right, so say we sold 60 items, and since we're in LIFO, we're going backwards. All 15, all 30, and then 15 of the 25. All right? So if we were to add to that 900 right here, the 1950 and the 1050 that we expensed, our cost of goods sold is $3,900. All right? Then all we have to do is we can take this cost of goods available for sale and subtract the 3,900. So ending inventory is 5,050 minus the cost of goods sold, equals $1,150. That is our ending inventory under LIFO. Our cost of goods sold is $3,500. All right, one more question here. Okay, let's see, what does this say? Okay, looks like we have a question on the average cost or weighted average cost method. It says, what is the amount of cost of goods sold for the year according to the average cost method? All right, so this is we're using a periodic system, so we need to do a couple of things. What we need to do is we need to determine how many units we have available and at what cost. So the first thing is we're going to add up these number of units here. And it looks like if we take 5 plus 15 plus 10 plus 10, we have 40. Okay? Then let's bring our calculator back over here. We have 5 times 61 in our beginning inventory is 305. Plus 10 times 63. Now let's see here. Let's start that over. 10 times 63 equals, whoops, I'm making another mistake. 15 times 63. 15 times 63 is 945. All right, and then 10 times $74 is $740, and 10 times 77 is $770. Okay? So we had 40 units that cost us $305 plus $945 plus $740 plus $770. And that gives us $2,760. Okay? Now, if we take those 40 items and we divide it into $2,760, we're going to get our average cost per unit. So let's just do that. Comes up to $69 per unit. Notice there was never a single time that we ever paid $69. In fact, the closest that we paid to $69 was $74, which is, $5 off. That's quite a bit. So our average cost is $69. All right. It says that there are 20 units of the commodity on hand at the end of the year. 20 units. If we had 40 available and now we have 20, that means we sold 20. So all we do is we say cost of goods sold equals 40 minus 20 times 69. Of course, this is 20. So 20, or $69 times 20, equals $1,380. $13.80 is our cost of goods sold under the weighted average cost method using a periodic system for this set of circumstances.